KPPC's event is the expiration of a large number of warrants, which could more than double the company's shares outstanding if all of them were exercised. This created a stock overhang. A stock overhang refers to an imminent increase in the supply of a company's stock, which hangs over the stock and prevents its price from going up. This happens because potential new investors expect that the increase in the supply of stock will push down its price, so they hold out for lower prices until the overhang is resolved, after the supply of shares has been increased and the market has had the opportunity to digest the impact of the new supply. Examples of such an imminent increase in the supply of available shares of a company's stock can be an institutional shareholder liquidating a large block of ownership, which increases the immediate supply of shares and it takes some time for the market to absorb. Or another example is an equity follow-on offering or a large amount of options outstanding, which can cause dilution of earnings if the new capital does not generate the same returns, or it can cause selling pressure from new investors that want to lock in their gains from the exercise of options by flipping the shares back into the market. Investors can capitalize on stock overhang through the following process. First, you need to identify the situation by searching news or filings for an impending stock issuance, where you know that the company will have to issue new stock and dilute existing shareholders. You should be on the lookout for warrants expirations, debt conversions, or a large amount of options outstanding. When there is a specific date attached to the event, the benefit is that you know when you should get in, prior to or immediately after the event, and when to get out, shortly after the event. Before deciding if or when to buy a stock with an overhang over it, you need to establish the dynamics that will determine the outcome of the event when the overhang is over. Will the warrants get exercised, or will the debt convert? This will depend on what makes the most financial sense for the holders of the warrants or the debt. You also need to assess the potential impact of the dilution in order to figure out the potential downside in the stock due to the change in its valuation. Only then can you make an educated bet, and you can decide further the mechanism that you will use to capitalize on the overhang. Will you buy the stock outright, or will you buy call options instead? The options will let you capture the upside if there's a lot of pent-up demand and not many warrants exercise, so there won't be as much dilution. But it's a more defensive way of playing the event, because you don't bear much downside risk if you're wrong in your assessments above.